All right, welcome back to the Storage 100 series. It is day 66, and I am Joe Downs with the Storage Moguls Mastermind. And today we're diving into a critical decision for every storage investor, choosing between a local bank and a national lender. This is a choice that will significantly impact your deal structure, approval speed, and long-term financing strategy. The financing landscape for self-storage offers two main paths: relationship-driven local bank or the scale-driven national institution. Understanding the fundamental differences is key to securing the best terms for your specific project. Local banks prioritize personal relationships and community ties. National lenders prioritize standardized processes and scale. We need to evaluate which approach aligns best with your current deal size and experience level. The better option isn't universal, it depends entirely on your needs as a borrower and maybe even the deal. And today, we're going to break down the advantages and disadvantages of each type of lender, and we will start by looking at the benefits of working with the local bank. And by the way, obviously, this is not SBA loans we're talking about. This is when you're going the conventional route. Local banks often provide a smoother entry point into commercial real estate financing, especially for smaller or first-time deals, because the biggest advantage here is the speed and flexibility that comes with a relationship-based approach. Local banks can offer much faster approval times because the decision makers are often in the same building. They value the personal relationship you build with your banker, which can lead to more flexible and sometimes customized terms. And this personal service means you aren't just a transaction, you're a client the bank wants to keep in the community. So for deals under $2 million, local banks are often the most efficient and practical choice. They can pivot quickly when you need to adjust a term or close a deal fast. This localized knowledge and personal touch can be invaluable when you're starting out. But this localized approach also comes with some inherent limitations. Because while the local banks offer great personal service, their smaller scale means they can't compete with national lenders on every front. The primary drawback is simply the size of the loans they can handle. The most significant limitation is the loan cap. Local banks typically max out between 3 and 5 million, let's say, on a deal. Their smaller balance sheets mean they sometimes charge slightly higher interest rates to manage the risk. And their geography is constrained usually, meaning they can only lend within a specific limited area. A local bank may not have deep expertise in self-storage either. So this lack of specialized knowledge can complicate the underwriting process sometimes. So if your deal is large or outside their lending footprint, you're definitely going to look somewhere else. And this is where the national lenders step in with their massive capacity. So let's pivot and examine the powerful advantages of working with a national lender. Because the scale of a national bank allows them to handle much larger, more complex deals with competitive pricing. So national lenders can handle much higher loan limits, and they can easily fund deals over 10 million. Their economies of scale allow them to offer highly competitive interest rates, and they provide true geographic flexibility, lending across state lines and nationwide. Many national institutions have dedicated divisions that deeply understand the self-storage industry. So this specialization means they can underwrite your deal with greater confidence and speed, provided it fits their box. So if you're scaling rapidly or targeting large acquisitions, national lenders are essential partners. But this scale and standardization also introduce significant friction points. National lenders offer great capacity, but the scale comes at the cost of speed and personal attention. So you trade the relationship-based service of a local bank for a more rigid bureaucratic process. The approval process is often much slower due to centralized underwriting and multiple layers of review. Their terms are highly standardized, leaving little room for customization or flexibility on your specific deal. And you lose the personal relationship. You become a number in a large system, not a valued client. Expect significantly more documentation and a more bureaucratic closing process. This lack of personal touch can be frustrating when issues inevitably arise during the closing. So for a simple, small deal, the national lender's process can feel unnecessarily complex. All right, so we've weighed the pros and cons of both types of lenders. Now let's synthesize this information to determine which lender is best for your first few deals. So your first self-storage acquisition, especially if it's under 2 million, I'd say the local bank is your ideal choice. They're relationship-driven, which is crucial when you don't have a track record yet. Speed is often a priority on a first deal, and local banks can move much faster than large institutions. They understand the local market and the specific asset you are buying better than an out-of-state underwriter. You're building a personal connection with the loan officer, which gives you flexibility down the road. And this relationship is a valuable asset, not just a transaction. But as your portfolio grows, your needs might change. So while local banks are great for starting out, national lenders are the clear choice when you're ready to scale. The key differentiator is the ability to handle multi-state portfolios and larger deal sizes, typically $3 million and up. That's where national lenders are going to offer more competitive rate shopping because they have access to a much deeper pool of capital. Their professional underwriting teams are built to handle complex multi-asset financing structures. They're comfortable with the kind of large-scale institutional-grade deals that local banks often can't touch. So we're talking about efficiency and lower cost of capital across a portfolio. So how do we put these two distinct approaches together for maximum advantage? Well, let's look at the hybrid strategy that successful investors use. Because the most sophisticated investors don't choose one or the other. They use a hybrid approach to maximize their advantage. So we start with a local bank for the first deal to build that initial relationship and secure a quick yes. This establishes your credibility and gets you into the game. For the second deal, you shop both the local bank and the national lenders. This forces your local bank to compete on terms and rates, ensuring you get the best deal possible. Once you have a significant portfolio, you transition into the national lender for scale. They can bundle multiple facilities and provide lower cost of capital needed for true expansion. This three-step process ensures you will always use the right tool for the specific stage of growth that you find yourself in. It's a strategic roadmap for financing your entire self-storage journey. All right, so to summarize our financing discussion today, remember this simple equation. Local banks equal speed, flexibility, and crucial relationships, personal relationships. They're your partners in the beginning. National lenders equal scale, competitive rates, and deep institutional experience. They're your partners for growth. The core takeaway is to use the right tool for the right deal at the right time. Don't try to force a local bank to finance a $10 million portfolio, and don't waste time with a national lender on your first $1 million acquisition. This approach will save you time and money. Okay. Hopefully now you have at least the 30,000 foot view of how you finance your first few storage deals to your 10th and beyond. And if you feel like you do, please like this video, especially if you found the hybrid approach valuable for your strategy. Also, subscribe to the channel to ensure you don't miss the next deep dive on financing, which would be tomorrow, or all the daily drops, tomorrow being day 67, where we'll cover what credit score do you actually need. And lastly, please share this video if you're in another mastermind maybe, or with a friend who needs this advice. They will definitely thank you later for giving them this clear roadmap.